Welcome to the deep dive. Today, we're diving into a really massive document, the One Big Beautiful Bill. Specifically, we're unpacking Title X-Lev, that's the part dealing with the Committee on Ways and Means. Now, this isn't just some dry list of policies. It's more like a blueprint, really, for some pretty significant changes across American life. Our mission here is to, cut through the complexity, give you the most important nuggets, especially if maybe you're newer to how these big legislative proposals can impact you directly. So let's get into it.
Yeah, what's really striking is just the sheer breadth of it, the ambition. It's aiming to reshape the economy and social programs in, well, pretty fundamental ways. It touches everything from, your individual taxes to big business incentives, even healthcare. It's a very comprehensive look at a proposed future.
Okay, so let's start where it might feel most immediate for you listening. Your personal finances. The bill proposes making permanent those lower income tax rates we've seen, and also the significantly increased standard deductions. Remember those almost doubled standard deductions from the Tax Cuts and Jobs Act? Well, imagine a married couple filing jointly seeing their standard deduction almost double again by 2026 compared to current law baseline. And here's something really interesting and new. Deductions for things like tips and overtime pay. For the first time, this bill actually creates above-the-line deductions for that kind of income, at least for specific years.
That's a crucial point. And for listeners who might be new to this term, above the line, it basically means these amounts get subtracted right from your gross income. So it reduces your taxable income before you even get to other deductions, like the standard deduction, often leads to a bigger tax break.
Right, that makes sense. So what do you think it signals then? Targeting common income like tips and overtime specifically for this kind of relief. Is it just about putting more money in people's pockets, or is there maybe a broader policy goal here?
That's a perceptive question. I mean, beyond the immediate boost for certain workers, targeting these specific areas, you could see it as a strategic move, maybe to stimulate certain sectors or influence the labor market somehow, or perhaps address perceived income issues very directly. And it's also paired with an enhanced child tax credit, going from $2,000 up to $2,500 per child temporarily, and a new $4,000 deduction just for seniors.
Okay, so beyond the immediate tax stuff, the bill introduces something called MAGA accounts. That's money accounts for growth and advancement. These sound like new federal savings vehicles, basically custodial accounts for kids under 8. And there's potential for a $1,000 federal contribution for newborns. Imagine starting a savings fund for your child that early with some federal help.
Looking bigger picture, it suggests a real focus on incentivizing, long-term financial security and specific types of investments. And this thinking extends to health, too, with expanded uses for health savings accounts, HSAs. The proposal would allow funds for things like fitness expenses, though, with annual limits, and also direct primary care services. Seems aimed at making health and wellness maybe a bit more accessible financially.
And what about businesses and communities? Particularly, rural America seems to get attention here. The bill proposes allowing 100% immediate expensing for new factories and certain business property, which means businesses can write off the full cost right away instead of, spreading it out over years. That's a big deal. It also launches a second round of opportunity zones. Now, for listeners who might not know, those are economically distressed areas where investments get tax breaks. This second round seems specifically tailored for rural areas with enhanced benefits like a 30% step up in basis.
Right, and that 30% step up in basis, what that means is if you hold an investment in one of these zones for at least 5 years and then sell it, only 70% of your profit, your capital gain, would actually be taxed. So yeah, that's a pretty substantial incentive to drive money into those specific rural areas.
Okay, but it's not all expansion, right? The bill also proposes some significant terminations and new taxes. For example, it speeds up the expiration of various clean energy and electric vehicle tax credits. We're talking credits for new EVs, used EVs, commercial ones, even home energy improvements, all set to terminate by the end of 2025 under this proposal. So, while some benefits are added, others are definitely being pulled back. For listeners trying to get the whole picture, how do these shifts balance out, like the cutbacks on clean energy versus the new rural incentives? Does this suggest a clear redirection and maybe some friction for industries in those curtailed sectors?
That really gets to the heart of the bill's philosophy, doesn't it? It clearly shows a reorientation of policy goals. Some might argue it streamlines things, targets resources better, Others will definitely see it as disrupting incentives or creating uncertainty, especially in green energy. It's a classic case of weighing different economic and societal priorities. The bill also brings in increased excise taxes on the investment income of certain private colleges, universities, and large private foundations. It's tiered based on their asset size. And there's a new 5% excise tax on remittances, the money sent out of the country, though there are exceptions for verified U.S. citizens sending money.
And there are also new ID requirements. Social Security numbers needed now for claiming several tax credits, like the child tax credit and education credits, moving beyond just a taxpayer ID number. And finally, there are measures aimed at efficiency and accountability, like using AI tools, apparently, to try and reduce and recoup improper payments under Medicare.
Right. And stepping back, there are also reforms proposed for the Earned Income Tax Credit system, designed specifically to detect and manage duplicate claims, trying to cut down on errors and improper payments there too. It outlines a kind of phased system. The IRS sends notices first, then might hold refunds, and eventually could implement a pre-certification process.
So wrapping this up, what does it all mean for you? This one big, beautiful bill, as proposed, it really outlines a significant shift in tax policy and economic incentives. It touches your household directly, tax rates, new deductions, those savings ideas we talked about, but it also reshapes the landscape for businesses, communities, and even large institutions like universities and foundations.
Exactly. It's a bill reflecting a very clear set of priorities, impacting everything from how you might save for your child's future to what kinds of cars get tax benefits and how major nonprofits are taxed.
So for you, the learner, this is more than just a list of policy tweaks. It's really a peek into potential shifts, where the economy might be headed, how different sectors, different individuals might be affected. As you think about these changes, maybe ask yourself, how might these broad strokes impact your own financial planning and the choices you end up making in the years ahead?